Bangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hello, welcome to the COB, this post-budget Wednesday. I'm Juliette Sarli. Great to have your company. What a busy day it has been for everyone in the markets, everyone in politics, everyone digesting what the federal budget means for them and their investments. But of course, the big news today was this massive fall that we saw from one of the biggest stocks on the market, CBA, getting close to a record fall, in fact, and its biggest intraday fall since COVID, really playing on the overall market sentiment. So let's have a look at where the CBO 200 is finishing the day's trade, down by 0.6%. The S&P ASX 200 also lower today, dropping by some 40 points or 0.5% as we head into match off, 8,630 points, setting a new 20-day low. So this CBA crash is really, I guess, the key focus for investors. Its biggest one-day loss since COVID-19 sell-off in March 2020. CBA's third quarter cash profit of $2.7 billion, missing market expectations. This was due to higher than expected bad debt provisions. Maybe a little bit of selling because of the CGT changes as well. We'll ask our guest Mark Gardner his thoughts on that coming up. Elsewhere though, the other big stock on the market, which yesterday overtook CBA as the most valuable company on the S&P ASX 200, or on the stock market I should say, is BHP, and it got another boost today, so further cementing its status here as the largest company listed on the market, rallying to an all-time high for a second session. We've got copper above $14,000 on renewed Chinese demand. And then the calm before the storm. This is Citi's call that Australian wages held steady, the growth in the March quarter, but Citi saying the result could prove to be the calm before the storm because the Fair Work Commission is weighing another large minimum wage increase that they say risks keeping inflation elevated, forcing further rate rises. The wage price index up by 0.8% in the quarter, 3.3% annually, in line with what the market was looking for. In the public sector, we saw higher childcare worker pay flow through into the data as well. All right, let's have a look at the damage from the banks. We mentioned CBA there. Wow, 10% lower, $17.56, $153.94 is where your CBA shares sit this afternoon. Westpac off by more than 3%, ANZ NAB also under pressure. Macquarie Group there, well, it is the outlier, isn't it? Rising by almost 1%. The miners, I mentioned the flow through into commodities, lifting BHP to a fresh record above $61. Rio also looking really solid, up 2% to $189.33. Minrets and South 32 looking good too. And then let's have a look at some of these consumer discretionary stocks. A little bit mixed, not too much of, I guess, an impact there from the federal budget. We know we're still going to be facing higher interest rates, but that cash back, that extra $250 that we're going to get, well, that's not going to come through until the next financial year of 2027-28, which a lot of economists I spoke to today said is quite good because the RBA is hoping that inflation will be back within their target band by then. Getting into the nitty-gritty though, we touched there on CBA having that massive fall. Westpac also came under pressure. Now, UBS thinks that CBA and Westpac are the most exposed out of the big four to the negative gearing crackdown. Elsewhere, Aristocrat had a really good session, up more than 13%. It reported a rise in first half profit, also expanded its share buyback program by $1 billion. Temple & Webster, well, it was down by more than 6%. Its full year 26 guidance has been cut. And they say it'll come in about 30% below what the market was looking for. Healius also plunging, lowering its full year earnings guidance and launching a strategic review of its Agilex biolabs after weaker pathology volumes and rising labour costs weighed on performance. All right, let's welcome to the COB Mark Gardner from MPC Markets. Good to see you.
Good afternoon.
You were just telling me off air, this is one of the, or if not the, budget that's had the biggest implication on investor sentiment in your career.
Yeah, I mean, look, I started in the mid-90s and probably too young around that, Costello changes, but essentially it's been fairly quiet up until that, up until now, really. This is a huge budget. I'm surprised. Look, I mean, CBA's result today, mildly disappointing, obviously, but I'm surprised that Westpac's not down by near the same. I think that negative gearing impact is incredibly negative for property investment just across the board, and and I think investors are very wildly underestimating what sort of consequences that's going to have, because we've had property go up forever, basically, and I don't think the government's probably thought through. They've just pushed a lot of people into 5% deposit mortgages, and then LVR is going to get pretty tricky if we get a pullback in the property price. So, for the first time in my lifetime, people actually are genuinely concerned about property. So, I think there'll be we maintain the negative gearing on the ASX and for share investing, etc. I think that's going to be a positive, but we were already seeing a very large flow of boomer investors or retiree investors who was already identifying how low the yield was, how expensive property was, and were selling and coming into a lot of our structured investments, like fixed coupons and things like that, around 12.5%, where they just like the income. So people were already starting this anyway, and I think that negative gearing particularly is going to up the ante there. So it could be a really good thing for the Australian market in terms of property. So much investing money has been taken up by property for so long that essentially you can, now shares are an option.
So this is going through into winners and losers more broadly. We can go back to the share investor in a moment. But so what is positive in your world is this new build, the triple tux cap package, but the impact here to these discretionary trusts and private health rebate is going to hurt.
Yeah, I mean, look, whilst that's a big negative for discretionary trusts, it'll be good to be an accountant over the next 12 to 18 months, I can tell you that. But that's more of a broad winners and losers in terms of the general populace. They were, I think the private healthcare rebate slashed, and that sort of affects older population as well. That's a pretty big deal and was quite unexpected. I get the point with the new builds, and where a lot of the concessions will still apply, but the supply issue hasn't been about being able to attract money. It's been able to attract labour and regulation, etc. And the discretionary trust, particularly, that's an enormous move. I mean, you're going to see so many wealthy families, family offices, like so many people across Australia that are going to have to completely restructure, and I think it's going to. I think from a personal perspective, it's probably going to hurt personal-based ETF, passive investing, and things like that, because that was always underpinned by the fact you got the CGT at the end, and you don't anymore. So you're going to have to look elsewhere. It still will maintain in your CGT within your super. That's protected. But yeah, that buy and hold strategy now is very challenged by by the change in the tax rules and
so you and I are not economists, so let's not talk about whether or not this is good or bad for young people, but let's talk about what you think it's going to do for equity investing, because the Australian Shareholders Association is saying, why would young people then invest in ETFs and things to try and get a deposit for a house because they're going to be hit by this CGT? But James Gerrish from Market Matters was saying, well, he thinks a lot of that money from property will go into the equity market. What do you think?
I think they're both right.
Yeah.
I just think it's the way you do it. So, I mean, we do a particular product for aimed at sort of young investors trying to build for that. And it's done via structured investments where you can control the CGT event and there's a fair bit of leverage in there as well. And obviously the negative gearing is still applicable, and we use options to backstop it, so it heavily reduces the risk. So essentially that product we custom built, we've been selling for quite some time. So yes, in that case you would steer back to equity investing, and I do think property was so far out of the reach of younger generation, they were already turning to shares. But I do agree with the Shareholders Association. But just going into one-to-one passive ETFs or that buy and hold and time in the market theory that financial planners endlessly spin, that has just wildly changed now because you haven't got policy supporting it. So you're going to have to look to invest in a modern way. Not those tactics of the past aren't going to work as effectively anymore. And you're just going to have to look for more innovative ways to do it. So yeah, it'd be interesting. I mean, we've thankfully, and we weren't expecting this to be as aggressive as what it was, but many of the structured investments we do took us out of banks, and we were less worried about franking credits, etc. And then trying to use that leverage to help people build that for those home deposits and things. So we weren't really it wasn't part of our investment thesis anyway. So we've been fairly lucky this has been good in terms of the stuff that we're selling. But there will be a lot of planner and accountant conversations over the next 18 months, and for the first time ever, you'll have to genuinely review your portfolio, and you'll have to look at those old holdings like CBA that everyone has, or the legacies, and you'll have to size up whether they're a good investment. So
yeah, one of the first emails I got this morning was from my accountant. I think you're right, they're going to make a lot of money this year, aren't they?
Oh yeah, we've spoken to quite a few today, and because we've got a lot of relationships with accountants, there's going to be a lot of consults on the books.
Best of luck to them. Mark, thank you as always. Mark Gardner there from MPC Markets. Didn't even get to US CPI, but a lot to discuss, and those really great charts that Mark provided us as well of the winners and losers. Getting back to stock specifics, of course, CBA was the stock of the day. Nadine spoke with Henry Jennings, Marcus today, and Andrew Wallant from DP Wealth Advisory.
I don't know what effect tax changes are going to have on people's, perception of this one, because, pre-1985 tax changes, all that sort of stuff. So it's going to be interesting how it falls out. But from a stock price point of view, it's taken a big hit. And I think, you probably should have sold it a little while ago. I think it's not going to perform brilliantly. But having said that, you don't want to be throwing this one out on a bit of a panic. So I would be holding this one for the time being, at least.
CSL, Cochlear, all the C's that Henry was just referring to, these hedge funds are just brutal and will just sell it. They'll stop it out immediately. So I'd suggest there's probably a little bit of that going on as well. But look, it's a hold for the time being. I think from a technical point of view, it's around that $148, $150 mark. If it can bounce off there, it's actually probably a buy. But at the moment, it's a hold.
10 stocks picked by you, 2 experts, 1 hour.
Let's get to the companies that have been nominated by you.
It's like a witch hunt over there. Everyone hates data centers.
Just remember that most of their earnings are offshore, so there's no franking credits.
The call is brought to you by Centuria, an ASX-listed property fund manager with $21 billion in assets under management. Want to diversify beyond equities? Explore the Centuria Sydney CBD Prime Office Fund at centuria.com.au.
All right, let's have a look at the leaders and laggards in today's session. Aristocrat there on its update, rising by more than 13%. Also some good gains from Parenti Global, Generation Development, Alcoa and Sandfire Resources. To the downside, I guess CBA is going to be there. There you go, down 10.4%. Temple and Webster too, after its guidance missed market expectations. And poor old Westpac being dragged into it too by UBS, saying that it, along with CBA, is one of the losers out of the big four banks on the back of the changes to negative gearing. All right, tonight, we've got to do the small caps first. Felix Gold down, up 20%. INE up 12%. The small cap losers today. Healius, of course, down by some 23%. We touched on that one earlier. All right, tonight, US April PPI core forecast, 0.3% month-on-month gain after 0.1% in the prior month. And the broader picture is meant to show us a reading of around 0.5%. We're also getting Eurozone first quarter unemployment, first quarter GDP, industrial production, and the ECB President Christine Lagarde will be speaking as well. Tomorrow, we have the Melbourne Institute inflation expectations, a couple of AGMs including Flight Centre and Ampol, plus earnings from Xero and GrainCorp out with its first half numbers. Let's recap where the market has finished the session, down 0.6% there. The S&P ASX 200 has finished lower by 40 points, 0.5%, 8,630. And we're basically back to where we were at the beginning of 2026. So we are unchanged when you take it all the way back to January the 1st. Now, I touched on the fact that the Australian Shareholders Association says that the budget will penalise long-term investment and investors. I'm pleased to say that Rachel Waterhouse from the ASA will be joining me at 11:10 a.m. tomorrow, Sydney time, for her take on that. So do be sure to tune in. But of course, we're live from 9:45 a.m. Eastern. We'll see you then.